section in discussing Asia's financial architecture. Let me start with a brief introduction of myself. Andrew Caney, your moderator for this session. I am the project director for the Asia Finance project with Fund Global Institute. I first came to Asia to live and work just over 15 years ago in the spring leading up to the Asian crisis of 1997, initially in Korea, now much of the past many years in China, and have seen really the twin themes we've been talking about. How can the financial sector, how can the financial architecture serve the needs of the real economy, and yet also continue to keep learned, as it were, not forget the lessons of the Asian financial crisis and withstand risks, whether they come from within Asia itself or indeed from the rest of the world, as some of the panel thought on earlier. Our theme now is trade finance, and I'll come to our esteemed and experienced panel in a moment to talk much more about trade finance. But just a few words about where we are. This is a panel discussion, but actually it's a bit more than that. We started working on trade finance back in January as the first real initiative within our finance research program. And the way we're doing that reflects the engagement and dialogue that we talked about with Professor Spence earlier this morning. That is to bring together practitioners from business, leading academics, leading policymakers, all together to really understand the issues and then to work through recommendations and solutions in a very interactive way. So we've had some of that dialogue already. We'd like to continue that dialogue today and share where we are with the research, but very much get your reactions and inputs to that. On the panel today, we have, starting farthest away from myself, Rakesh Bhatia, who's the Global Head of Trade and Supply Chain for HSBC. Clearly brings very deep practical experience of how the trade financing is working, the opportunities and the challenges. Then Christian Edelman, who's a partner of Oliver Wyman Consulting, a lot of experience in trade finance and been very helpful in working with us on understanding the data and the issues and then potential options. Dr. Chang Myong Ri, currently Chief Economist with the Asian Development Bank, who brings a very broad Pan-Asian perspective, but in prior roles also has very good policy experience within Korea and indeed in the banking sector in Korea. And finally, of course, Andrew Shung, who I think needs no introduction as president of the Fund Global Institute. So with that, I'd like to hand across to Andrew, maybe to talk initially about, so why are we talking about trade finance now? In many ways, we could have started the Asia Finance project, and we've chosen trade finance.
Thank you very much. I'm really delighted here. These are, on the right-hand side, our partners in this work. And let me say why we chose trade finance. Now, the thing, you've heard this theme over the last 2 days. Finance must serve the real sector. Banks started as trade banks. Let's remember this. They were exchange banks. They were trade banks. They financed the trade, right? And today they've evolved, into the derivative area where they do make a lot of money. But, we must never forget that trade is what keeps the world go around. We exchange goods and services. And the banks, help finance that. That's a lifeblood of the whole issue. So it reflects our, what I really want to describe here in the next, 10 minutes is why do we choose this? Because, when we started thinking about the new Asian financial architecture, it was very clear when the crisis happened. The thing that failed, Asian banks and fund managers didn't buy that much toxic assets. But we got killed through the trade channel, right? I mean, peak to trough, GDP dropped, up to 10% of GDP for some countries. Trade dropped 20%. Trade finance dropped 20%. Now that was the one that was a killer because the once the trade slowed down, and Asia is a major trade engine and manufacturing engine, the trade stops. It was reputed in China as many as people, 20 million people, started losing their jobs. And luckily, the prime pumping that occurred, brought this back. But the trade finance happened because Lehman Brothers, which was not that much involved in trade, collapsed. That stopped the counterparty transactions at the wholesale level, that means the banks won't clear. And then they run off the trade finance because trade finance is only 120, 140 days in the area. So guess what happened? 10 years later, three years later, the major reforms, have it addressed trade finance? Hello, Basel rules says trade finance should have a risk weight higher than before. Hey, we didn't cause this. If I'm a trade guy, I would say we didn't cause this problem. How come we end up paying for it, right? And a lot of the attention was even much more on the fixing the derivative side, but the whole of Asia, experts like Rakesh, Christian, and Dr. Wee, who will tell you that he's the thick of this, very clearly, has understood that this is the area where Asia cares about. Now, why then is trade finance so critical for all of us? Well, trade finance is part of the supply chain. Point number one. Trade finance is the linkage. There are the bank trade finance and then the supplier trade finance side. They are the linkage between the multinationals and the SMEs, right? And so if that trade finance breaks, right, the SMEs immediately lose confidence, lose the orders, and lose the jobs. So it very clearly, trade finance is at the heart of financial reform. So we looked at that. Now, very clearly also, if we allow finance to have that volatility, which is exactly the point that Mike Spence was talking about, stability is actually a great public good. Okay? So maybe what we should think about is to actually isolate, ring-fence trade finance. That's what our project was called. How do we ring-fence trade finance? So that, okay, you guys, gamble all you want, you collapse all you want, but let the trade finance flow. Okay? And another illustration from the lessons of this crisis. You have got to have a living will. What's a living will? Living will says that if I collapse, I need to know, what I wind down. First thing I wind down is my trade finance. Because that is the lowest, the fastest to run off. Okay, and if I run that off again, jobs will be hurt. The whole engine will be there. So we do need to think very clearly. I don't want to go into the regulatory side and how we fix this, but I want to give you first an overview. Now, that overview comes from a very important point that I've been trying to figure out about the way the world works. Finance is a network. Supply chain is a network. Okay? And within networks, there are huge feedback mechanisms that we haven't fully understood. So we've looked at the world in terms of silos. We look at each our specialist area, and we forget. Now, trade finance has been a little bit like Cinderella. It's been taken for granted. And the reason why nobody pays that much attention to this is very straightforward. In the old days, the trade finance is the banker that rises to the top. Today is the trader. I'm not to the trader, the FX trader or the market trader. So that priority is very important. So in the study, as we got the numbers out, it became very clear what is the ROE on financing trade finance? 5%. What is ROE on proprietary trading in FX, equities, etc.? 20% upwards. So are you surprised that the big players are now moving their best resources, their best people into these, what I personally call the riskier side of it, and less helping the real side? But we are exactly in what I call the Ford moment. Ford started paying his workers better. Why did he do that? Because he says, when I pay them better, they buy my cars. Trade finance is the same issue. You help the SMEs grow, society prospers, and that's what we need to do. Now, given that we're talking about systems, what the FGI methodology is not just to look at the macro side, which is very often the economist, the policymaker, but we really need to figure out what is it stopping the system, and that's what I call the ground level, the micro. What is it that the micro doesn't happen? So it's not just about the top down, again, I go back to Mike Spence's view. It is about bottom up, and it is the feedback interaction between the two that ultimately determine where the risks are, right? And so what has happened before was that policies didn't understand the micro, and the micro guys didn't understand what the policy was all about. And so the policy translation is problematic. The outcome of policies don't get what they want. And the present set of rules very clearly determine that. Now, very, very quickly, to sum up, what we try in FGI in terms of methodology, why we selected trade finance, is what I call system acupuncture. 20, 30 years ago, acupuncture is still kind of voodoo science. Today, they realize acupuncture is very important. It links up the qi or the nerve system. But if you put the needle at the right place at the right time, the system either self-heals or actually begins to change. Trade finance is exactly like that. It's a sort of a network that you take for granted. After you take them for granted, you see them, right? Or you don't see them. And then, but if you work at it, you'll be able to make that change. So from this, I think all my colleagues here, we're very grateful to all of them for being our partners in this project. They bring insights to it that I never had before, and I'm sort of still learning on this issue. But we hope that you will be able to see how we approach it, that we review for you from a case study what the major policy issues are. Thank you.
Andrew, thank you for that perspective. I like it very much in that spirit. I have to turn to Rakesh to bring both the perspective of what this means for HSBC's customers and for HSBC as a business. What are the opportunities? What are the challenges? So that we can continue this dialogue.
Thank you, Andrew. I think the way we see it today is that there are sort of three very key aspects which are impacting not just HSBC but the world trade and the trade finance industry. I think the first is the current business environment. The second is the developing regulatory regime around banking in general and trade finance in particular. And the third is the currency issue. And I'll talk a little bit about all three of them just before I talk more about what we are seeing in our business. I think in terms of the business environment, the US has been anemic for almost 3 years or so. And just yesterday, I think they revised their first quarter GDP growth rate downwards, so it's still, limping. Europe, the problems are very well known, and they're only getting worse right now. And Europe is the largest trading bloc of the world. So if Europe is slow, the world trade automatically slows. China, for the 7th month in a row, the PMI is below 50, indicates a contraction, and that's a source of concern. And we've seen India released its GDP growth figures yesterday, and they were the lowest in, I think, about 9 years or so. So a lot of the engines or big constants of world trade are actually really slow at this point of time. And that has a tremendous impact on the overall trade, which impacts growth, which impacts jobs, which impacts prosperity. Some of the things Mr. Shane was talking about. The second issue is the developing global regulatory regime. And Basel III clearly is actually not necessarily singling out trade to come out with regulations which are going to be tough, but it is actually not giving trade finance any specialist or preferential treatment the way Basel II gave. And that is what is creating the problem, that all products of banks are being treated with the same brush. And that's where Mr. Sheng was talking about derivatives and trade finance requiring a similar level of capital, similar level of liquidity, and similar level of leverage in terms of the ratios. And that's clearly a problem. The interesting aspect of that is that it's debatable at this point of time whether US will follow Basel III norms. European Commission and European Parliament have just signed off that the actual implementation would be a lot more dilutive than the global Basel III norms being suggested. So whether it is in leverage, whether it is in liquidity, whether it is in some of the other aspects of Basel III implications, it will be much more dilutive as applied to Europe than at the Basel III level. So there is a real risk that there is a possibility of almost regulatory arbitrage, where Asia, not having a common voice, is exposed to Basel III at the toughest level, and the other two big trading blocs of Europe and US are not subjected to it. And that's a big risk for Asia, which incidentally, and there's an Oliver Wyman report which says that by 2020, 60% of global trade will have an Asian leg. So the largest trading bloc will be following the toughest regulatory norms for trade finance. And that's a very negative from where we sit and evaluate it. And the third thing I wanted to mention about was the currency. I think almost 85% of global trade is in US dollars, 7% or so in euro, and 4% in RMB. And 50% of that RMB is UK, is Hong Kong and China, and 20% in Singapore and China. So the shortage of US dollars, which is now a common theme, particularly in the European banking system and in Asia to a large extent, will continue to impact the ability of non-US banks to fund trade finance. And therefore there is a real need to actually diversify some of the sources of funding and move into different currencies, RMB being one of the major ones that we should be looking more and more towards for participating in the world trade. And specifically the intra-Asia trade should be more and more focused on RMB. So that's some of the things that we are seeing from a global perspective. From our own perspective, we are the largest trade bank. We have about 9% share, and last year the total transaction which went through us was about $500 billion. And we are actually proud to say that we would be probably the sort of largest supply chain banker of the world, linking a exporter in Bangladesh to Walmart in US. But we see that we have to do a number of things to keep on developing in what is required by the market. I think the issues around the European banks and the deleveraging by the French banks and the other European banks have created a real issue in the commodity and structured trade space. So that's one area where we see real demand coming through. The other is on receivable financing and open account. There is a lot of opportunity that is coming through in terms of financing what was earlier done on direct trade. As the risk increases in the market, as new supply chain lines develop, the requirement for trade finance increases, either through the open account channel or through conventional trade channels. And the last bit where we see a big role for HSBC going forward is to work with financial institutions globally, because in a number of countries in the world, we are not directly represented, but those countries participate in world trade, and we want to work with financial institutions there to actually push the global trade in those countries. So that's how we see things develop.
Thank you very much, Rakesh. Let me move along now to Dr. Ree and get his perspective from his experience work with ADB in Korea.
Thanks very much. It's my honor to be here. Thanks, Andrew, for inviting me here. Actually, I fully share the importance of trade financing, as Andrew just mentioned and Rakesh just mentioned. But on the other hand, in the last couple of months, when I traveled to the academic society and the other region, I would rather say that there's still a controversy. It's whether the trade financing is important is still controversial. And they showed data in 2008 and 9. They agreed that the trade really plummeted. But whether the trade financing, lack of trade financing was the real cause of this big drop of trade, they believe is still controversial. They show some data in every region. that the decrease of the trade volume is larger than the decrease of the trade financing volume, and that is cited as evidence against the importance of trade financing. And some micro study shows that the SMEs and companies with low credit rating and their trade financing volume hasn't decreased much more than the other the high credit rating company. That evidence is also cited as an evidence against the importance of trade financing. And one example is, I think World Bank publication is quite nuanced, but if you read it, their book, it says that still the jury is out, rather than concluding that trade financing is very important, which is really against what I feel in Asia, and especially when I was a government officer in Korea in charge of trade financing and financial matters. After 2008 crisis, the first turmoil and the first cry from businessmen and in the market was to secure the trade financing. So, but I was also a former academic. I was also a former the professor who believes regression result. So I mean, at the imbalance, in some sense, academics still say that the jury is out. On the other hand, my real experience saying that trade finance is very important. So I thought about why there is a discrepancy. I think data. So that's why I want to emphasize that in your study, the data is a key. At this moment, most of the evidence focus only on the mostly the letter of credit, and when they say that the decrease of trade financing, they focus on the bank intermediate letter of credit. But on the other hand, trade financing has a full value chain, right, from the pre-shipping and shipping and to the delivery to all the destination. So there is no comprehensive data set yet to cover whole the trade financing channel. So that's one thing. The other thing is that anecdotally we know that more than 80% of the trade financing is usually non-bank intermediate. It's credit each other for supply and demand. And when the crisis happens, usually the company which rely on to their counterpart may be shut off from this credit line chain. Then they have to apply for the bank credit. But on the other hand, bank is not willing to lend their money during the time crisis. But this kind of demand-supply gap, I think, won't be captured by the statistics gathered by the bank, because previously those companies are not in their data set. And the third, I think, reason may be trade financing, as Andrew mentioned, the maturity is very short. So, but in the 2008, 2009 global finance crisis, G20 and all this, because of the expansionary monetary policy, after 2 quarters later, the global economy had a V-shaped recovery, and we are back to the normal track. In some sense, maybe the 2008-9 crisis period, using quarterly data or semi-annual data, may not capture the severity of the drought of trade financing. So there are many reasons the data is kind of ambiguous. That's why I really, actually rely more on, when I make a judgment, rely on more practical evidence. For example, ADB, from 2008, we start to trade financing guarantee program. And 2009 alone, the growth rate of this trade financing facility guarantee program was about 240%. So we can see enormous increase of demand from the low-income countries. That is, I believe, is indirect evidence of the importance of trade financing. In Korea, when Lehman Brothers collapsed from August to September and October, all the businessmen come to my office, say that now it's a big problem. I have all LC and I have all the pipeline things, but there's no trade financing available. And please give us some dollar. You have 240 billion reserves. Why don't you give us some money? But at the time, as a Korean government officers, we cannot use that very effectively, freely, because we don't know how long is this thing's gonna continue. If you know that, if you knew in advance that global economy will have a V-shaped recovery, we could have used it. But given that we don't know how long it's gonna last, at the time we are very careful, and we don't want to also give the money through the exchange rate market, because then we cannot differentiate speculators versus real trade finance demand. That's why Korea government decided to provide trade financing through the non-exchange market. So that means the domestic, the exchange, the currency market. So through the Korea Exchange XM Bank, we provide dollar to the company, which actually shows us some evidence of trade financing. So there are many indirect evidence that really shows the importance of the trade financing, but most important research topic maybe how we can get the most systematic data, which can convince the many people that trade finance is very important. And especially you mentioned the regulations, so I think the impact of this Basel III kind of evidence is very important. So let me just conclude with what to do then. I think let's assume that we have data and we can persuade that trade finance is important. First thing, the immediate concern is what Rakesh just mentioned, the change of Basel III. And I understand the Basel's argument. So it's important to penalize the speculative transactions. But on the other hand, it's important to avoid good financial transactions, such as Andrew mentioned, trade financing. So I strongly believe that it's much better to allow 20% credit conversion factors for trade financing as in Basel III, rather than increasing to 100%, so increasing the cost of capital by 5 times. So I think the Asian countries must have a unique voice, one voice, to emphasize that at least for the trade financing, they have to apply the Basel II's 20% credit conversion factor. That's very important. And I mean, there can be many things, but from a policy point of view, I think another important one is the role of the some MDB, regional development bank like ADB or the CMIM, which we just created, Shanghai Initiative Multilateralization. Their problem of CMIM is still the total amount of capital is increased to 240, and double basically. But on the other hand, it's just a pledge. They don't have money. So actually, then it's a bilateral swap. When something bad happens, then if it's an individual shock where some other countries can help others, it may be effective. On the other hand, if it's a global shock, such as Eurozone turmoil, every country will be affected. I doubt it, which Asian country will lend the money to each other. So it's much important to have a fully funded system like IMF to make CMIM effective. And if we have a fully funded system, maybe the first step is to use this money to guarantee the trade finance. So using this as a guarantee. One problem, ADB actually doing this credit guarantee for the trade financing, but internally the problem is that this guarantee has the risk weight as 100%, same as a loan, which is kind of silly, but so it's an internal regulation. So I think this kind of things has to change. Otherwise, the trade financing and the guarantee program for trade financing may not be effective. So if you believe trade financing is short-term and less risky than other loans, the guarantee on trade financing also has to have a less capital burden on doing it. Finally, I think the most important thing is for Asia, trade financing is in international currency denominated terms rather than own currency. For US and Euro countries, when each country is just using expansionary domestic monetary policy, that can actually act as a counter-cyclical policy as well as solve the trade financing problem. But on the other hand, in Asia, even though we do the lots of domestic expansionary policy, it won't help the trade financing in terms of dollar. And so how to secure that? In some sense, I think there are lots of things that Asian policymakers can do, especially by expanding this bilateral trade settlement system between Hong Kong and China that can be applied for other Asian countries. And it really depends on the central bank's willingness to do it. And if they do it, then they will definitely reduce the dependence on the dollar or euro, and then trade financing can be effectively dealt within the region, and that is a great step to start with. Thank you.
Thank you, Dr. Ria. You covered many topics of very, very high relevance to this discussion on how to both ring-fence trade finance and to make sure there's the right trade finance to support Asia's growth. Maybe finally I turn to Christian to discuss some of the findings of the work we've been doing together with the support and overwhelming support on trade finance and some of the potential options for improving the situation, particularly around ring-fencing.
Thank you, Andrew. And before going into the potential solutions, let me just add a couple of more points around the discussion that we've had on the macroeconomic importance of trade and trade finance for Asia. I think Andrew had a very good point at the beginning that trade is really a network product. And when you look at it across Asian trade flows, 80% of these trade flows, at least once in the life cycle across these networks, require at least one form of financing or risk mitigation, and risk mitigation also including credit insurance and other products. I think that underlines the strategic importance. If anything breaks down in that long value chain, it will have an impact on the real economy. And also when you compare the trade statistics, and just take one other one, Rakesh mentioned the 60% share of Asia's share of global trade flows. When you compare trade over GDP, Asia on average is about a factor of 3 to the mature economies. So again, that shows the strategic importance for trade finance for Asia. Secondly, I think the Basel topic is very interesting. We discussed that at length, whether it's the right medicine or not. But what's interesting here, Basel III was largely created to address a problem that we had in North America and Europe. And also, as Rakesh had outlined, there was increasing determination not to implement Basel III to the extent that it was originally proposed. But most of the Asian regulators are still supportive for it. So it's like almost the medicine has created for a sick man in Europe or North America, the healthy man in Asia is going to swallow it. Whether that's the right strategy remains to be seen. And one final point I make, and then I come to the potential solutions around this. I completely agree. We'll never find the right regression whether trade has collapsed first and then trade finance went down, or whether trade finance collapsed and that had an impact on trade. It's certainly both components here, but what we have seen both from data of regulators that we worked with and many banks across the region, every bank has run down their portfolio in their non-home markets. In your home markets, you're supposed to continue to it effectively, but in the 2008 crisis, post-Lehman, you've seen it from 3 regulators in the region, all of the foreign banks have cut it down. It's a short-term, it's a self-liquidating product, it's the easiest way to reduce the balance sheet effectively. There's one other component. When you look at a comparative statistic, the cost for freight, take the Baltic Dry as an example, in the Lehman crisis comes down effectively. And of course, you adjust that because there's lower demand, hence you reduce prices. Trade finance acts effectively in the opposite. So what happens is prices shoot up because the banks don't trust each other anymore. And what it ultimately means, yes, there's probably financing availability still out there, but at costs which are largely prohibitive, which is also to be kept in mind. And finally, one point around the market structure, which we also need to look at. Globally, 5 banks account for about 40% of the global trade finance revenues, including HSBC at the top end of the group. In Asia, that share is a little bit lower, but you then have a broad range of also European and North American second-tier institutions accounting for a large chunk of it. And many of these institutions today are deleveraging, which has an impact that we already start seeing in Asia. Now, what that means is they're advantaged by the network economies that they have, these global banks, because if we're able to handle a trade from both legs of the transaction, of course, you're more efficient in terms of the risk management solutions and so forth. And that has largely held back Asian banks towards deploying their liquidity in the market. And the other issue there is they don't have access to a lot of the US dollar liquidity, and as Rakesh mentioned, the Asian trade is largely still conducted on US dollar. And that's an interesting point, because what we see in Asia, we see a massive shortage of US dollar liquidity in the banking sector and in the corporate sector. But at the flip side of that, we see a huge amount of dollar liquidity within the central banking system, particularly take China and Japan. So one of the solutions we'll discuss in a minute is how can you deploy that liquidity, the US dollar liquidity, that sits into the central banking system, and potentially put that out into the private banking sector system. Now, the solutions that we're seeing, and I'll split it across what the global banks are doing, what the Asian domestics are doing, and what potentially the regulators and the central banks across the region could be doing. Global banks, what we're seeing, they've started some securitization transactions in order to run off certain portfolios to bring that into the institutional investor market. But typically, even despite the fact that they're global, each of these banks tends to have a relatively strong focus on certain parts of the market. So it's not a fully diversified portfolio. And what institutional investors are looking for is largely very, very broadly diversified portfolio. So what we're discussing with a few banks is to create what we call a trade facility, where you source assets from different banks and effectively make it tradable. It's almost a money market substitute type of product for institutional investors, and potentially also for corporate investors, because again, the attractiveness of trade finance is risks are very low of that product. And I think that has been demonstrated in all the data that the IIF and other institutions have been pulling together. That's happening, but it may take a little while. So can Asian banks step up now in the meantime? The problem, or the short answer to that, is probably not yet. To some extent, they lack the network. They're short of US dollar liquidity, and unless we see that switch towards more Asian currency-dominated trade flows, it will be difficult for them to step up. And let's keep in mind, trade is a relatively narrow product in what I would call the broader transaction banking product that is being offered. So corporates are not just looking for the financing of their letter of credit. They have cash management requirements on top of that. Clearing settlement solutions that they need to provide. And if you're not having that broad network of clearing capabilities across multiple currencies, again, it makes it difficult to really penetrate client segments which are in the mid-market and above of it. So let's now discuss what potential solutions we've, together with the Fund Global Institute, come up with, and I think we're at the starting point of that discussion, but let me flesh out 5 potential ideas that we've seen. And one is a guarantee-led type of model. What you do have in the market today is Exim banks and export credit agencies that provide direct guaranteeing on the risk of the transaction to the corporates ultimately. What you could be doing as a central bank or a regulator is to provide guarantees to banks who confirm letter of credit, basically taking the other bank's credit risk of that transaction. And again, that would ensure certain risks are being managed on a more effective basis. The problem with that solution is it typically works throughout the years, but as soon as you run into a crisis, Lehman style, it will no longer work, because these crises are liquidity crises, and in a liquidity crisis, a guarantee is not going to help you. So it's potentially a nice idea during the regular times, but not for times of crisis. The second component we discussed was around ring fencing, and you have these ring fencing discussions in the UK with a separate split of certain investment banking activities that are being ring fenced out of the core banking system. What you could think about theoretically is, say, that a certain part of the corporate deposits that any bank takes in Asia needs to be ring fenced for financing trade flows effectively. Again, that would probably require quite a bit of monitoring from the respective central bank, and it's probably not an easy to implement solution, but it's a tendency towards, say, part of what you're sourcing as the corporate deposits, you need to redeploy that into the corporate sector. The third solution we had was direct purchases, and it was a point that was made in the earlier panel much more around infrastructure finance, where the sovereign wealth funds and pension funds couldn't step up their efforts in that regard. And similarly, you could argue in the trade finance space. When you read the rationales for the sovereign wealth funds, they typically argue we're here to support the future economic growth of our country. Well, trade for almost all of the countries is core of the future. Hence, you would certainly have an argument for saying they should be financing, or at least taking their stake in financing the trade flows. And then is what we called the Smart Eltro scheme, which the name should not imply that what Europe is doing these days is not necessarily smart, but much more a point around being a rifle shot approach, if you want. So that the central bank would discount trade receivables effectively on a rather short-term basis, and again provide liquidity into the market. And the final component we came up with was an industry-led fund, where we say the banks are not going to solve it, the regulators are not going to solve it, hence let's set up something directly from the industry, a fund, and you would tax certain transactions, for example, feed up a fund that then would be able to provide liquidity in certain times of stress. So those are, in combination to what we see happening in the private banking sector, potential solutions which we believe, particularly here out in Asia, given the macroeconomic importance of trade, should probably be discussed in more detail.
Thank you, Christian. I'll move in just a moment to questions. I just want to say a few phrases based on what we've been hearing. Firstly, it's very clear that there is the central role for trade, and there are a number of initiatives that need to be taken. I think some of the questions we heard in the first session about what is the role at the national level, what is the role at the Asia level, and how does Asia find a voice globally, come very sharply into focus here. And we kicked off by talking about feedbacks. We had the question in the previous session about, is there an Asian financial architecture or a global financial architecture? Of course, everything is linked. At the same time, we need to take very specific areas and understand the specific issues and opportunities there to use that for action. And we see trade finance as a very valuable way to focus those efforts at the early stage. This links also clearly to questions around renminbi internationalization as we talk about the US dollar liquidity. So the panel might want to come back to some of those. Before we do that, I really welcome questions from the floor, both on reactions to the importance of trade finance as an issue and the initial ideas and options we're exploring as a way to strengthen this for Asia's future development. So can I see questions from the front, please?
Thank you, panel. I think this is a very good introduction to the subject matter. I talk here as an ex-banker, I'm retired, I'm not doing anything. So certainly ROE is not what I'm concerned about. I'm just talking about that and how to get started in the economy around the world and getting to recession is stuck in this situation. And I think from that point of view, intuitively we all know that one way or the other, it must do trade back to basic again as far as the economy is concerned. But talk to the bankers about it. You understand the practitioner bankers will not understand that because he got other kind of pressures. And these pressures are both external and internal in terms of the asset allocation of the bank and the liquidity of the bank. And ultimately, of course, the struggle for ROE during that period. And here, the trouble with trade financing is effectively the world's got out of place, and a lot of bankers promptly given a high concentration of the number of people that are doing trade financing. You go to the figure 40% of the total trade financing is done by 5 banks, and your case 9% of it is your bank. And I think as practitioners, we didn't have the figures down to be understood yet what we can face in terms of keeping trade financing going on. Because we understood what networking means. We understood networking means it's something that you want corporate banking, you can't avoid it, and it's part and parcel of you to offer that kind of services to your client. Even though it was probably, I'm talking about this mainly in the 80s and 90s, and as we go to more universal banking concept, it get even more personalized as to what's happening to those of us who got to make the final asset allocation to the bank in terms of risk management, what we had. And he get really down in line in terms of how senior management see these things, and they take it almost for granted. They know this is the most unprofitable part of the business as far as they're concerned. They're doing it just for waving flagship because they're doing corporate banking and they got fed up with that. They said, look, I'm not going to compete with it. And you mentioned 5% return now. In reality, I think for a lot of us, it was never a 5% return. You know, basically, in order to get that kind of a client and to take them away from HSBC, take them away from the 5 banks or what have you, you're lucky to get something like 1.5% return in order to get that trade, right? And why do we do it? Relationship again. And why do we do it? Other trade-offs like currencies and currency trades, which you need to boost up your volume of market, right? So, and yet we were caught because we didn't have enough developed sort of branches internationally to draw the sort of not an international division. And during the crisis, this is the crux of the matter to me, which is effectively, I think the panel is sort of looking into the subject more deeper. Look at this question from bringing it up slightly higher from micro to macro sort of aspect about it, which is the whole complex of the whole system. By the time we get into universal banking, this question that you mentioned Basel III, which is a new thing, but during my period, obviously, Basel II was not beginning. They were struggling with Basel II. Right? Even then, we had a problem with the rating issue. And the rating issue was just not the central bank. As a stakeholder, effectively, I mean, from a shareholder's point of view. I mean, the rating agency itself is the biggest corporate. I mean, and I think not enough attention is being focused on the rating agencies. I mean, damage that they do to the industry. right? Because in trade financing, what do? I mean, effectively, it's a question about acceptability of name.
Yeah.
Right?
Can I maybe get some reaction from the panel around this question of the attractiveness of trade finance in the broader portfolio? As the other feedback and context we take this line, maybe anyone, do you want to start, Andrew?
Let's go back to the policy issue, Rashid, because the thing that actually, I just give you a reaction. You look at trade finance as a micro subject, but actually it has massive macro implications. Yeah, and I just want to reinforce this particular point. What I realized from this was, we're looking at it the wrong way around. Now, why is it the wrong way around? Most of us talk about trade finance as if it was international trade finance. But where can you make money? You actually, the best form of trade as services is domestic trade. Not very well measured, not very well measured. Now, how do some Asian banks make money from this? Danamon Bank started in Indonesia the wet market financing, right? You station a guy in the wet market, and actually the people in the very simple, sort of fish, meat, chicken, sort of vegetable sales, daily trade, they were actually getting 30% per year interest rates, but, finance on a daily basis, right? Now, if you then think through this concept, you realize that most of that trade finance in a lot of domestic trade has never been measured, has never been properly financed, and the poor SME is struggling to get that, and that's why the Wenzhou financing of this world is willing to pay the massive financing. So, then how do you integrate that domestic trade with the international trade is the game for banks, how to make money from this, from that network effect, and from the policymaker, how to make that trade flow all the way from domestic to international as a profit-making, finance to support the real sector economy issue. And frankly speaking, as somebody who's worked in the national system, this is the area where policymakers have paid least attention to, because that is where the job creation is, and the domestic trade creation really comes from. And I think it's, whilst people are going to subsidize, SMEs, they haven't figured out they can actually do this very effectively through, sort of trade finance and trade aspects. Sorry.
Yeah. And as a sequel to that, I think that there's further to that. I think even at a macro level, if you talk about the economy a bit, you look at Asia, for example, which is what we're talking about today, in terms of 60% of the future trade. And I think Asia is a little more complex in terms of how it works. And for a large extent, the one we're competing with our multinational guys who squeeze you to the wall in order to get that trade. So who do we want to finance it? We were forced down the line to finance the small boys who are SME in a way. But it is also, look, in a recession, who do you think that hit most? Effectively, as small boys, in terms of excellence, which is certainly again, right? And how do you stick your neck out and take that risk? If somebody else on the top level, the regulator of government is and give us the guarantee or what have you. Because this guy hasn't got enough of credibility now for us to be financing at rate 0.5% of water, right? And if that squeeze goes on and on and on, it gets tighter and tighter. And this is something we've got to get out of it in order to get the trade progress.
Yeah.
I think that's really my main point.
Could I maybe ask Rakesh to come in on this question around, as HSBC, which is often in a different position to some of the local banks, then maybe Christian and Dr. Reed would like to share some perspectives on how other banks are looking at this. Some of them maybe don't have the strength of position that HSBC has in the market.
Yeah, I think that this is an interesting point about the attractiveness of trade finance as a portfolio within a bank. I think I definitely speak for HSBC. I think Andrew said that most of the banks have started as trade banks, and certainly we started 150 years ago as a trade bank. And if you see the recent commentary even from our group CEO who was here earlier, that trade is our heritage product. and we will make sure that it remains center stage for us. I think we look at it in terms of our portfolio products from three angles. The first is that it is a very critical part of the entire relationship with our customers. And when I say about relationship, it just doesn't mean the Walmart. I think we are equally comfortable because of our heritage being in Asia for 150 years or so with the SME in Bangladesh or Vietnam or in Egypt or in Mexico. We are a lot more comfortable than most of the other multinational banks. So we see that as a very critical part of the relationship. The second attractiveness of trade finance is the lack of volatility. So I think a lot of the other products we talk about might have a much higher ROE, but the kind of volatility we see in trade finance is significantly less. And that adds to the attractiveness for it as a very key portfolio product. The third aspect is that in terms of pure profitability, I think we see that as attractive. The kind of returns we've been able to get in terms of the entire cross-selling piece is attractive. So I wouldn't rush to say that it is not viewed as profitable or attractive within the bank's portfolio. I think at multiple levels we see the attractiveness. I think if I look at it from the industry viewpoint, more and more banks, with the experience of the last 5 years, are attracted by the flow products and the transaction banking products, whether it is cash management or trade, are very critical parts of the flow product, and that's adding to the attractiveness. So we do see more banks entering, more from the regional and local players than from the global players. And that is where the entire debate about Basel comes into play, because if you're going to make it very difficult for banks to come into the space, you will have a problem in terms of attractiveness of this particular field.
Just a few points to add. I think trade finance historically has also been a good entry product into a relationship, because by definition it's an area where you can attack the domestic banks, because apart from the example that Andrew had, any type of international trade, it's easy for a global bank to say, well, we're much better positioned to handle your trade flows because we have a global network. And we've seen that throughout Europe, where in the last decade, a number of the banks, as part of the common market, have moved into new markets. They took trade as a lead product, and some of the leading Asian banks have been doing effectively the same. So it is a good product to go into a relationship. And I think on the economic side, certainly what we've seen, the gap has narrowed between trade and other products on the wholesale banking side. Certainly pre-Lehman on the fixed income products, most of the banks at the top end were making 25–30% of ROE. That's difficult to achieve these days because the capital requirements have increased quite a bit. So we've just looked through the real ROE based on the data that we have from the 10 leading global investment banks. And when you do that, you basically see that also on the fixed income side, given it's a massive scale business, certainly it's what we call that flow monster approach, that you need flow in the core product. And 5 to 6 banks have that effectively, but the economics, only about half of them have attractive economics north of 15% ROE, others haven't. And in Asia, on the equity side, just to complement the loop, it's a relatively unattractive business from an ROE side. The point is exactly, if you're only just able to offer a narrow trade product, you're being squeezed out of that. And I think the only final point I'd like to make here is, when we discuss that Basel III topics, there's certainly the temptation to say, well, anything trade-related is good and anything derivatives-related is bad. I think we need to clearly make the distinction that a lot of the flow derivatives are as important as trade finance is ultimately, because if US dollar denominated trade is the majority of what we see in Asia, you need an FX hedge attached to that. You need flow swaps, interest rate swaps, in order to hedge certain macroeconomic risks that you have in your balance sheet. So just to put that into perspective, and once you have that, it allows you to achieve a certain ROE, but the point that Andrew made at the beginning, unless we have in Asia a situation where trade, and I would, let's say, the broader corporate and transaction banking product creates a return which is more attractive than other parts of the business, you're not going to bring Asian banks to primarily invest in that area.
Thank you. Question in the front here.
Thanks very much. I think Andrews has made a very persuasive case for the choice of this topic, and it really is absolutely profoundly important in supporting the real sector. And of course, from my perspective, trade finance is Islamic finance because there's always an underlying transaction, either in the form of the movement of goods or the provision of a service. Now, I want to go to the Basel III issue really because I do realize that there are two distinct issues. One, of course, is the instability in a financial system that could arise by barriers to trade finance. But Basel III seems to me to be a little bit different. And I want to ask the panel whether, in fact, there are flexibility provisions built into Basel III which would allow us to weather some of these difficulties. For example, I remember in November that the chairman of Basel III, the Basel Committee, mentioned that going forward, sorry, that phrase has just cropped up again, the Basel III will allow a more flexible use of its core equity requirements for trade finance. In particular, they will no longer require that, for example, Rakesh has mentioned the case of shipment of goods from Bangladesh. You won't have to use the sovereign credit rating of Bangladesh to assess that transaction. You'll be allowed to use your own internal rating methodology of the risk. Now, I haven't actually followed, I follow Basel III very closely, but this is the one area where I haven't followed it enough. So I'm not sure where we stand. Has Basel III actually gone forward and allowed that flexibility? And if it has, does this help us to address this vitally important issue?
Someone would like to take that? Rakesh may.
I think that you're absolutely right. I think the BCBS did make that statement that they will allow the maturity floor waivers to go below the sovereign ceiling. So they allowed that particular flexibility. I think, but the number of issues which are going to restrict trade finance under the new Basel regime are actually much more wider. So there's on leverage ratio, on liquidity ratio, on asset value correlation, on maturity floor waivers for all the products. It's a very big issue, and all those four, Basel is treating it very clearly as one bucket. All products will be treated the same, and no differentiation will be allowed for trade finance. And I think from where Basel comes from is that if you allow for one product, then other products will ask for it as well. So there's no specificity for trade finance products. Having said that, as I mentioned, just I think it was about 4 weeks back, that European Parliament and European Commission have agreed to all the representations on these four issues which I just raised, and therefore it's very likely that the European financial institutions will not be subject to it, but the global Basel system is not yet accepting them. So there's a real risk that if Asia is following Basel III and Europe is following its own what we call CRD4 regulations, then there will be a regulatory arbitrage and the Asian financial institutions will be at a loss.
Dr.
Now, just one thing which I may be missing is about the recently they proposed global CP regulation. Actually, most trade financing in Asia is provided by the global CP. And in global CP regulation, one of the proposals was to impose the capital cost based on the extent of cross-border transaction. So in some sense, if you have a similar businesses, but if you have more cross-country transactions such as trade financing, you will be penalized. So I think these are examples that they have to take care of.
Just one final point maybe. I think you're right with your example on the sovereign rating side. Basel has exempted them. But the key issue that we're having on Basel still today is the leverage ratio. And that's a new ratio where Basel said, given trade is primarily an off-balance sheet product, we have 100% credit conversion factor effectively. And that's the core of the problem. So there's always been discussion, has been increased from 20 to 100%. No, for the core capital requirements, it's still at 20%. But in addition, to measure the leverage ratio, 100% factor is applied. And there's been a lot of data submitted to the Basel Committee that said trade is a low-risk product. And but Basel then said, well, that's good and nice, but that's not what we're trying to address with the leverage ratio, because the leverage ratio is, in addition to all these fine-tuning that we have, a very, very simple ratio. We add up everything on a fair and systematic basis, and that's it. Now, whether that is right or not, in the line also that Rakesh outlined it, that you may want to have some advantages for trade products and so forth, but that's the rationale that lies behind the leverage ratio, and they haven't addressed this, and they're not willing, at least as I see it, to concede on that.
I think the problem might be just a conceptual one, that Western economies have forgotten about trade finance. And we have a different approach to trade. I think it's so important.
Yeah. It's very clear from our study that, for example, Middle East trade finance will be very, very much also affected by the Basel III rules. But the issue really boils down to, and this is a little bit technical, but I'll get back to the macro side again. The Basel III rules, are the classic problem of one size for all. And once you get down to the complexity, how you get away with for the big banks, if I may say so, IRB, internally rated, based model. Which basically say everybody can do their own risk model because you rate it with their own risks. So why don't we have national IRBs? I mean, if we think that trade finance is lower, and that's my understanding of what is happening, with the Chinese rules, is that in the Basel rules, with respect to the risk weight for the trade, they can actually put it lower than the actual market. Now that's the sort of issues that you have principles based at the global level, and then much more kind of national nuanced or industry nuanced rules for specific areas. But sorry, let me.
I think this approach is desirable, but in some sense cannot be effective, because we do that, then we can rationalize our decision. But then the credit rating agencies and Western financial experts will say we are intransparent, not following the global rule, and they will discount our ratings. So it's kind of, that's why it's much better Basel to do some. Experts say we can do that and it can solve problem. If we do it our own way, they will criticize Asia is intransparent.
Well, maybe we should have a transparent way of dealing with this.
I was going to, but you go ahead a question.
I was just going to comment that.
Yes.
That's the issue, is educating and helping them understand that it is a transparent way of doing it. And this is where I think Asia has to take the lead in educating the West on how to do it properly.
Let me just go back, because we were constrained for time, on how we see the way forward. The issue critically hinges on, if you do not, from a policy perspective, if you do not reward finance to serve the real sector, it will take a speculative leverage route. Okay? That's a heart of the policy issue. Now, how should you do this? There's one way to do this is actually what the Germans did, but unfortunately under EU rules they abandoned it. As you recall, the Mittelstand, which is the SME, was financed through a very simple discounting domestic trade bill system, right? Whereby if the bank finances a small SME for trade, that bill can be discounted with the Bundesbank, right? And of course, under the EU rules, they said, no, this is discrimination, this is subsidy, etc., which I think is nonsense. I mean, unfortunately, the Bundesbank has abandoned this, but I think maybe we should think about Asian central banks doing this again for particularly domestic trade, right? So that the cost of funds, and then the banks will be earning the spread rather than having to pay for the funds. This first point. And secondly, you would be rewarding credit culture at the SME level, right? And then thirdly, because Asian countries are much more trade oriented, if the standardization of data and credit management can be done for both domestic and foreign trade, because it's only the identification of the user, you're going to change the whole SME financing culture bring them into the modern area rather than leaving them to their own devices, which is exactly what's happening. Okay. So the punchline is, countries that have got the CMIM currency swap arrangements could actually use for example, renminbi ringgit, the renminbi rupiah swap arrangements to actually backstop traders. So that in the event that there was a shock that happened, actually this would ensure that the regional trade does not get killed by these external shocks.
Okay. Is there one final question from the floor? Over there. Simon.
So Simon Cox from The Economist. So much of what we've discussed has revolved around the return on equity of trade finance, its attractiveness in terms of risk-adjusted returns. But we motivated the discussion at the beginning by what happened after the Lehman shock. And Mr. Edelman made the point that that was really a liquidity crisis. It wasn't really about default risk or really risk-adjusted returns. So I'm just wondering how much of our discussion is really addressing that acute problem of a liquidity crisis, and how much of it is just a broader discussion of the market dynamics in normal times.
That is why I emphasize this in Asia is kind of specific character, because it's liquidity, especially in dollar terms. So in Western countries, they can issue their international currencies. So it's a part of the domestic monetary policy. But here, securing the liquidity in dollar terms is really independent of domestic monetary policy. So that's what I think Andrew is emphasizing. We have to come up with some solutions, which is maybe as a regional safety net can be one solution. But as I mentioned, it's not yet funded, so it's not that effective at this moment. And that's what I think, in my opinion, that's what the countries which can print out the international currency must be feel responsible, and they have to share the scenarios in normal times when these things happen. So it cannot be addressed by Asian countries alone. It's more. That's why this issue is related with the international financial architecture.
Maybe Andrew had a few final points.
This is a critical central banking question. Isn't it very odd that during the Lehman crisis, that Asian countries who had huge dollar reserves had to undertake a swap with the Fed? Is it an anomaly? We've got dollars, we can't use them. We have to swap it with the Fed in order to get those dollars. Now, why is that? You have to ask yourself that question, right? And the answer is actually, central banks can give as much liquidity as possible to the domestic currency. But even if you hold some of these foreign exchange reserves, you might not be able to use it, because if you lend it to your domestic banks, they lend it to the Lehman counterparties, you're dead. The money goes in, you can't come out. So actually, Asia really needs to think through the lessons of that crisis and rethink that liquidity issue. Because that liquidity issue was thought. What is the whole purpose of large foreign exchange reserves? Insurance. But at the point of insurance, you can't use that insurance reserve. Something must be wrong. You need to completely rethink this game, in order to understand. And so, what has central banks done? This time around, the same as last time around. But last time around, HKMA was scolded, lectured to intervene in stocks. Today you use junk bonds, right, to intervene in the market. Okay, so the game has changed so drastically that you really need to rethink the game. And we're saying, let's go back to basics. We come back to that fundamental point. We go back to basics. Use trade financing as the true collateral, which is the base for activities, and then central banks, collateralize, help finance real activities through the trade side, and then rebuild the financial system on that basis. I mean, we don't, we'll get another derivative crisis on our hands.
Thank you. On that note, let's draw things to a close. We will continue our research on trade. There's clearly a set of very important issues here, both around ongoing attractiveness and in ring fencing, but also very clear linkages to questions like R&D internationalization and the global voice, the Asian voice in global regulatory affairs. I'd like to thank the panel for their time and sharing their expertise, and then there's a good and wholesome lunch provided for you. Many thanks. Thank you for your question. Thank you so much.